Hey, welcome back, everybody, to the Financial Advisors Workshop. And this is the show where we talk to financial advisors all across America, and we hear some of the best practices and some of the best people in our industry that work with the public and advise them on their finances, make sure they meet their goals. Today, we have Sreeni Meka, and he is a financial advisor with a long story history of how he got into this business. So welcome to the Financial Advisors Workshop.
Oh, thank you, Brian. Thank you for inviting me to this podcast. Thank you so much.
Glad to have you. You're an Indian American, and it's interesting, and you have a very different perspective. Could you tell us how you, first of all, came to America and what you were doing before you became a financial advisor?
Well, thank you. Yeah, mine is a long story. I came from India to pursue my higher education, master's in mechanical engineering. I chose El Paso, Texas, and I did my master's there. Then I moved to Minneapolis and I started applying for jobs, and I couldn't get a job in mechanical engineering field. Then I found a book in computer book on Visual Basic, and I learned a week or so. Then I made a resume and faxed it, and the same day I got a job opportunity, and that I started my career as a computer science engineer, then the mechanical engineer. I worked
Okay.
20 years in multiple companies, mostly Fortune 500 companies in Minneapolis, Chicago, and mostly North America, some companies in Canada too. I was a management consultant at E&Y, and I worked in Chicago. And then I also worked in the same role in Deloitte and Touche in Chicago as a management consultant. Then finally, I moved to Memphis as a taking care of the data warehouse as a forecaster from technically uh, in in a small pharmaceutical. No, it's a very big pharmaceutical company. I had a branch in Memphis. And while I was there, I went to business school at University of Memphis. I did my MBA there, and then I started my CFA. I prepared CFA, and after a while, I didn't have satisfaction with the job because the learning curve was plateau. I didn't see any challenge. So I thought, and I've been investing honestly since 1994, 95 days right after college, once I started making money. And actually, this is a interesting story. I made real good money. Whatever the money I make, I used to invest in stocks. And those days, internet is like a everybody was making internet days, and I made good good chunk of money. Sometimes, in the momentum days, I used to double my money in a week. I was thinking, man, I'm a superman. I'm a 5-star guy. But
Right.
I, until 2000 March came and it wiped out everything. And as I said, I could have gone to an advisor, a financial advisor, or somebody who has a knowledge, and they could have helped me. Hey, don't do this kind of crazy things. I didn't do that. I learned my mistake from my mistakes, and then I changed my style as a value investor. Followed like Warren Buffett style, mostly value investing, get to know the companies and all that. And I also knew about my weakness. I'm good at technical side, but not at the financial accounting background. So when I moved to Memphis, I went to University of Memphis to do my MBA. Straight A's, I got all, and I used to talk to professors in the finance and accounting. I used to grill them rather than they ask me. I used to grill them, ask multiple questions. Luckily, nobody used to get upset. They used to answer my questions and anything related to markets and accounting and all that financial questions, which was a great experience. And one fine day, then I took a portfolio management class in the final semester. I realized, and one of the and all the tough questions at the end of the chapter used to be CFA questions. I thought, what is CFA? I did not know about CFA Institute, how it is and what it is. So then I called the local CFA charter. I Googled and I found CFA local charter, and I asked them, "Hey, I wanted to know about CFA. What a charter? Can I come to your meetings?" And they said, "Yeah, we'd gladly invite you." And then I went to one of their meetings, and they explained. They when they're meeting, I was talking to all these big shots. They explained to me how the CFA helped them, how their career level went up from lower level to higher level. I thought it's a great challenge. So I started CFA career preparation. And all the CFA was like a very in-depth into accounting and finance and about capital markets and derivatives and all that. I don't want to exaggerate. It's just, the pass rate is only 6%, right? Out of 100, only people come out. I mean, I'm not exaggerating, but since 1962 to 2024, only 190,000 people got the charter all around the world. I mean, it took me a while, but finally I made it. But it
Made
was,
it.
it's hopefully it's worth it. And but bottom line is, then I started my advisory firm. I quit my job in late 2014 because I was not happy with what I am doing.
Mhm.
So I started small financial advisory, mostly with money with from friends and my own money, family money. And later on, it started adding I started growing up. And a lot of people used to ask me, I used to say CFA charter holder, and people used to say, "Hey, are you not CFP?" So more familiar designation than CFA because more at the retail level, more people know about certified financial planning. Then I did certified financial planning also because we don't have to take the classes. All we need to take the challenge exam. I took the challenge exam. They awarded me CFP. But CFP added value about tax planning,
Yeah.
uh, estate planning, and from planning perspective, that's the best curriculum you have in the CFP. And
Yes.
CFP is more in depth into equity analysis, bond analysis, capital markets, those kind of things. So I have both. I wear both hats when I deal with the clients. That had added some. I mean, I think I would say I'm okay, average guy. I'm better than like person like in an engineer or a doctor with no finance background. So that's what I am.
That's great. So you started right in with your own firm. You didn't go to work for a warehouse or anything. You started your own firm right away.
That's right. I'm a school of hard knocks. The lessons I learned through it's personal investing. I did same thing with the advisory business, and most of my knowledge was theoretical knowledge when I started, especially with the CFA has also planning advisory business. They cover all the bigger issues about the planning and investing. Same with the CFP. But those two added some theoretical experience, but most of my lessons I learned through talking to the people managing the money and how people act and react when things go up and down. And my as an advisor, we all do to calm down the people when things are going down and slow them when things are so irrationally high, when things are going sky high. And you don't make money every day. At the same time, you don't lose money every day as long as you diversify.
Right.
That's
So when you started with some family money and everything, and then how did you build from there?
I was lucky enough. So my clients, they saw the difference, what the way I manage the money. So they started spreading the good word. And I gave seminars, I gave talking to the people in public and this and that. But most of I would say 99% of my client base is either I know them or my clients know them. So it's all with the good word. The people say, hey, this guy is good. He works above and beyond and above and beyond. And he takes care of our money as his money, and then he addresses the issues and challenges as they go through.
Yes. Well, good. So now you manage the money as well, right? Since you're a CFA, you actually run the portfolios too. How do you do that?
That is correct. Yeah, typical financial advisor, mostly they focus on the planning, and some of them they do their ETFs and all that, and fund managing with the funds. The reason I do with the individual portfolios is I save my clients 1% or 2%, whatever the fee the funds charge. They don't have to pay that additional cost. I create the portfolios by doing the equity research and my extensive 29 years of experience, not just picking the stocks just because you heard in the media or you hear in the TV or something like that. Rather, I do have my own screening process and pick the companies with the valuation where the downside risk is less, and have the upside potential. The growth rate is higher. I purely follow Graham Buffettian style. So
Okay.
basically, the valuation is extremely important, and then I add the growth component. So pure valuation techniques, they are not moving the needle for past 15-20 years unless there is a growth component in it, and it's just hard to move. So basically, I follow the Munger, Charlie Munger, and Warren Buffett, the investment style, and
Mhm.
how they analyze it, how they pick their stocks, and pretty much I mimic them, I copy them, and also I do extensive research, reading their annual corporation annual statements, quarterly statements, attending into their quarterly meetings online, and some of the annual meetings I go. Though I'm a small fish, I talk to CEOs and CFOs and say, hey, I put my hard-earned money, my clients' hard-earned money. And one time I said to one of the CEOs, I don't want to mention the podcast, and he said, "Hey, all my hard-earned money, my clients' money in your company, you better do well." And he laughed and giggled, and he said, "I'll take care of it, Sreeni." He know my name in person, but they escalate. That's what I do. When I put so much money, I am guardian of the money. I go and talk to them anytime I get a chance, and of course I listen to their quarterly meetings every quarter and with wherever I have money in it.
So how many families now do you work with?
Close to 50. I don't have exact number right now. I would say 50 plus 50 to 60 families,
Okay,
around 100 accounts or so.
great. And what is your asset base up to now?
Right now we are at 25, and it's the 25 million, and we are growing faster. By end of this year, hopefully we'll cross 30 million, and we're on the fast track. That's what I'm because of the clients' referrals and the way I've been approaching.
That's great. Well, good. And do you do financial planning?
I do limited financial planning, and when I talk to some of our clients, they may have multiple advisors. Some of them are there, some of them I'm the sole advisor. Basically, I take their inventory and talk about. Most of my clients are relatively younger, and some of them their client kids are going to school, college are going to be in college, and I
Right.
plan for they're like a three-stage approach. One, the kids going to the college, and two, after college to their retirement, and three, their post-retirement. So I basically approach a three-phase approach. And because of my background, I can do the math relatively easy. I don't need a software package, of course, though I use money tree and write capital and those kind of things. But mostly I put it on pen and paper and Excel spreadsheet and give it to them. These are the targets. This is the amount you need to save. This is the amount you need to reach to the goal. And also recommend them. This is the amount of insurance you need because you both and wife and husband you're working. If something goes wrong, what is to maintain the same lifestyle? How much insurance they need to have? So I
Right.
recommend the insurance needed so that they don't overbuy the insurance or they don't underbuy the insurance. So those kind
Right.
of things to be, and I try to meet them at least twice a year. Some people I meet a lot more than what
Good.
but I
Good.
agree. More is better, but sometimes the clients I follow up, please come and stop by.
So now that you built this firm, what do you think the uniquenesses are of your firm, and why are clients thrilled to be with you?
That's right. The very good point is you need to have the clear understanding, great understanding in the capital markets, especially the good example is 2022. The markets were going down crazy. A lot of people, some managers, they put money into bonds, and some people moved into duration adjusted to the long term because to gain more interest because the interest rates were pretty close to zero. So anytime the interest rates going higher and higher, bonds are the ones take a big beating. So that's where you carry your experience and understand the capital markets both and at the bond side and the equity sides. And two, I create a custom portfolios, SMAs. A lot of the people, unless they have a big chunk of money, they don't get access to a CFA charter holder at the bigger firms. But I myself, a CFA charter holder in a smaller firm, And I have extensive background in equity market and equity research. And just to give you an example, I've been managing a portfolio at the Interactive Interactive Brokers. That originally we started in 2014 October. My portfolio returns from there, the gross returns were 15% per year, so a little higher than S&P 500. Interactive Advisor still manages my portfolio. They show the data from 2019 onwards for past 5 years. Yet since inception, from that time, it's 20.1% annualized return. That is purely in equities. I'm not like a portfolio manager. I'm an advisor, but the thing is, my batting average is definitely not below average. I do well as far as the investments are concerned. Especially when I put the equity portion of the portfolio, I try to do far better than market. That's what I do. So
Good.
basically, I'm a different type of advisor. A typical advisor is like a more into planning side and more probably mutual funds and ETFs. My end is I play as a portfolio manager. More or less like a portfolio manager than compared to the typical advisors. So we both have strengths. Don't get me wrong. My strength is at this side.
So since you're so involved in the portfolio management side, what do you think of the markets here?
Markets go high and dry sometimes, so it's markets never go straight up, and markets never go down straight. So right now, it's kind of some kind of I don't say irrational, but some kind of exuberance right now, because the interest rates are 5.25 now. Fed is assumed to cut the rates by end of the year. So inflation is coming down relatively. I mean, from 9.25 to right now 3.1 is a great work what Fed has done, and and I think this 2024 is the election year, and the economy is humming. Most likely, the market is going to end positive, at least upper single digits to lower double digits. That's my capital market expectations. That's what I am guesstimating.
What do you think the risk is of a big collapse here, like inflation coming back and interest rates having to go higher, and a big collapse?
That's what it is. Fools rush in 1970s. That's what Fed did. Fed mistake was they cut the interest rates yearly, and then they fixed it again and again and again until they went way high in the interest rates. Right now, it's another way around. We learned from the lessons. We jacked up the interest rates very high above the inflation. In 1970s, Fed kept inflation interest rates 100 basis points above the inflation. So right now, and until 1990, Fed Alan Greenspan kept 100 basis points, at least 100 basis points above the inflation. Right now, the inflation is at 3.1. Hopefully, it'll come down to little less than 3. So the target rate for Fed is no less than 4%. So market is guesstimating like 200 basis points, 300 basis points. It's not going to happen. It's going to happen at least 100 basis points above the inflation. If inflation drops to 275 by end of the next year, so 2025, if it is inflation is around 275, 21, and then we go for 3.5, 3.7, that is the target rate, and that's my personal target based on the research I have done. So that's what.
So do you think they're going to lower rates then if they get inflation down?
Most probably end of this year. Like if not right away in the March or May, definitely sometime like right July, August, that time frame, because the inflation came down remarkably down 600 basis points came down. So the only big hurdle to this is a housing market. Right now, housing. I did some research. I'm going to publish a letter tomorrow in LinkedIn. Um, what it is the average median house price is right now is $420,000, and median household income in the United States is $75,000. Let's say if you put 28% the bank loan, So the qualified, PITI, for the mortgage prime rate, mortgage payment in interest and taxes and insurance. The max a person can pay is around 21,000. The family could pay. So that gives you ability to buy at 7% rate. If you reverse engineer, the maximum house you could buy is $220,000. So that is the median price an average family can afford is 220,000. We're talking about medians. You may make like $500,000, or somebody make like $50,000. I'm talking about median. So the median house an average family can buy is 220,000. The median house right now is 420,000. So there is some gap, not gap, a huge gap. So anybody generation Y right now, only 13% of the people own the house. So 87% people either renting or staying with the families. So there is a big gap. So market is not digesting that. So people saying cut the rates, cut the rates. That's not the solution. So we shouldn't be rushing to cut the rates. And it's good to have the lower rates, but we need to feel the pain. Society as a collectively for all the spending we have done for past 3-4 years, there should be a consequence. This is the consequence. Luckily, inflation came down, which is good. And still, inflation that's what they call downward sticky. Wages are downward sticky. Inflation is downward sticky. It doesn't go down right away. So coming from 9 to 3 is easier. 3 to 2 is the tougher. That's what I see.
Yes. So it's possible that rates might go up.
Rates may not go up, but definitely they'll come down, but slowly they go down. But the long-term rate, it's a different scenario. But short-term rates, they're going to go down.
Yeah, interesting. Well, that's great. Well, good. So, I like to say at the end of our discussions, you have the floor basically, and it sounds like you have a great practice and you have a great idea about how to run money, and people love you for that and your ability to do that. Is there any other message you'd like to send the financial advisor community today, since you're on a national network right now, and about 1,000 people are going to hear this over the next year? So what would you like to tell them? Like your main message about being an advisor?
Yeah, thank you. I'm not a big guy, but I'll try my best. This is an auspicious business. When you are an advisory business, the higher ethical standards makes the huge difference. Integrity brings the customers to us. Without the integrity and ethics, the business doesn't make sense. So maintain the customers' confidentiality and work for the best of the customers and take care of the customers. They will take care of us.
That's a good message, and you do a great job. And very impressive that you started from a standing start. You didn't go to work for a firm. You built it all on your own, and it's very, very impressive. So you're a great example of what our industry has produced. Great people working with the public, and they love working with you, and your business is growing. And congratulations. Thanks for being with us today on Financial Advisors Workshop.
Thank you so much, Brian. Thank you for inviting me to your national podcast. I appreciate it.
And we are going to come back again later on with another great interview, someone just like our guest today. But thanks all of you for being with us on Financial Advisors Workshop. We'll be back again, and over and out for today. Thank you so much.